Hello, good afternoon, and welcome to HYCM's online trading workshop with myself, Giles Coughlin, a currency analyst and a hedge fund trader, and I'm looking forward to taking you through this next hour. Just as you're coming on board, I was going to say hello to folks. Hi, Nadir, welcome back. Nisa, Tan, Van, good to have you on board. If you could just let me know in the questions column or the chats. Oh, Nadir, you've already beaten me to it. You've said hi. That's super. I'm glad you can hear me okay. Before we start the session, as is normal, I'm just going to be going through the explanation that as we're looking at trading setups and examples and different aspects of trading, this is not trading advice. What the aim of this workshop is to educate folks to understand how I view the market. So the idea is you see how a professional trader looks at the market, so then you can begin to learn to put these things into practice for yourself. So that's just to make clear that it's not, oh, morning Van, morning Nisa, good to see you guys. That's super. So that's just, I hope that's clear. It's not trading advice. It is simply education, so you can see how a professional trader views the market. We'll look at the outline of the session ahead. What we're going to do is we're going to look at a handout and apply the handout that I've given to you to the market as we find it right now. We are approaching the start of the US session. And so this is something that I say regularly is before you start opening the charts and trading, you need to understand the context of the market. And that's really what this is about, is explain the context of the market so you can see that some trading currencies are more suitable to trade than others. That's essentially what we're trying to do. If you notice on your GoToWebinar panel, you'll have a handout page and it says Workshop Guide January 22nd. If you click on that, you should have something opened, and what you should see is you should see a form like that. Okay, and that's what you're looking for. You're looking for this handout where you're looking back, looking forward, looking at the charts, looking at your risk, and looking at the outcome of your trade. And as I've said a few times, I've tried to do a workshop that is repeatable. So the idea is you take that handout, print it off, put it by the side of your computer. Whenever you come to the market, at the start of a session, you would use that as a guide to help you understand how to respond to the market. So we'll be going through that handout one section at a time, so you can see how I go about using that how I using that template for myself each and every time I look at the market, and that's become intuitive to me at this stage. But when you're learning, you want to make sure you have a checklist, and then it'll become intuitive for you. The handout, you should all have it. Workshop guide. If you want to open up your trading platforms, your demo accounts, open that up now as well. Got the workshop guide, make sure you've got that open. Again, email suggestions to the support team here at workshop@hycm.com. That comes through to me, and we'll be working our way through a number of the different topics that people want. So there's something you're thinking, oh, I don't understand that, or I really don't get that. Maybe something in the week you're trading and you're thinking, oh, how did that happen, or what went wrong there? Maybe just email the suggestion to workshop@hycm.com. So that is the beginning. So if you turn to your handout, this is a small copy of the handout I've just got here on the page rather, and you will be looking at the first section, looking back. Before you can look at where you are and before you can look forward, you have to look back to see where you've come from. That is very, very important in financial trading. Imagine if you like reading, imagine just picking up a book halfway through the book. If you picked up something halfway through the book, if you picked up a book halfway through, you wouldn't just start reading, would you? You wouldn't understand what's going on. You have to start from the beginning. And it's very similar in the way when you're trading. You need to understand the context of the market. So we're going to be looking back, and this is going to be quite helpful because when I did the FX a week ahead yesterday, there was one, really big event that was going on, which was Theresa May's Brexit Plan B that she was speaking about in the House of Commons. And that big event, dominated through the European session into the US session and was kind of the major theme of the market at the end of last night's US session. So we're going to get a good sense of continuity, and we're going to see how one event flows into another event. So what we'll do now is we'll get going, and this was the big event. It was from the previous US session, so that's not last night's Asian session. That's yesterday's US session, so virtually 24 hours ago. Okay, so we're looking back at this US session, and Theresa May had to bring her Brexit Plan B to the Houses of Parliament. Now, Nadir, there's a problem. What's the problem, Nadir? No screen. Aha. Right. There we go. Let's just check that's all working okay. Is that screen visible now? Okay, that's it. Thank you for letting me know. My apologies. There's a button I have to press. I haven't pressed it. Very sorry. Okay, now this was the situation that Theresa May had to give her Brexit Plan B to the House of Commons. She wasn't expected to do any changes, okay? But as I was saying on Monday, there's been a fundamental change in the pound's outlook. And that's what's happened is a no-deal exit from the EU is looking less and less likely. So Theresa May was never expected to come up with a great plan yesterday. Okay, everyone knew she couldn't really. But what the market is focusing on now is this second aspect here. Okay, this no deal exit from the EU, that's the worst case scenario for the pound, and that was what the market has been fearing. At present, there's about a 10 to 20% chance of a no-deal exit from the European Union, and it's got less, okay? So there's less chance of the worst case scenario happening for the pound, which is why the pound has been appreciating recently. From about January the 11th, I noticed a change. There was a technical issue. I could see that was going to change the outlook of Brexit. And this is what we're having, and that's what's happening now, okay? So Theresa May, some of the key things, she was a bit ambiguous about extending Article 50. That's what the market had been rallying on. If we go to the pound US dollar pair, what we'll see is that this was when Theresa May's deal was rejected here. That was her plan A that was rejected. And initially the market sold off, but it was brought straight back up as people realized, oh, there's much more likely there's going to be an extension of Article 50. Price extended, rose up and hit that 200 exponential moving average, sold off. Now, yesterday, we were looking at price as it found some support here. And here's a little workshop for you guys who were here. Whereabouts is a sensible place to define your risk if you thought that the pound was going to appreciate against the US dollar? Where would be a sensible place to put your stop loss, given the technical positions of the 100 exponential moving average, the 200 exponential moving average, and the 50 exponential moving average? Where was a very sensible place to put your stop? See if you can answer it in the questions. Let's have a look if there's anyone there who can do that. So either Nadir. Okay, Nadir, if you were going to go long, okay? So say you're going to go long, and the blue line is the 100 exponential moving average. The red line is the 200 exponential moving average. Let's see again. So anyone else? Where would be a sensible place to place your stop if you were going to go long on the pound US dollar pair? If you thought that, this is going to be appreciated. Yeah, Nadir, that's right. It was here, and this is where I was outlining yesterday, a sensible place to put your stop, congratulations Nadir, was underneath the 100 exponential moving average. Because if we thought the pound was going to appreciate back up to the 200 exponential moving average, a stop underneath the 100 exponential moving average would be the price at which we knew we were wrong. So if price went down through that stop, we'd know, okay, we've got our analysis wrong. It was quite clear as well on the 4-hour chart. If you look at the 4-hour chart, you could see here, okay, you can see that price touched the 50 exponential moving average and was bought up. Now, yesterday, as Theresa May was revealing her Brexit plan B, I thought we're going to get exactly the same thing happening as happened with her plan down here on the 16th of January. I thought I can see exactly the same thing happening. Price sold off and then brought back up, and that was exactly, and I bought up around here and sold there. I think I showed you the exact trade, and I thought, oh, are we going to get the same thing again? So I placed my stop underneath the 50 and the 100 exponential moving average, and I looked to go up to the 200 exponential moving average. Now, price came back down and stopped me out because I was at break even with all the volatility that was going on. I didn't want to hang around on that situation too much. But I am back in the pounds, and I will show you how I got back in today with some key data that came out of the London session. But that's right, you can use the exponential moving average to define and limit your risk. And yesterday was a really good place and a really good example of where and how to do that. And if you just kept your stop there, you can see you'd still be in that trade if you wanted to. I didn't, because of the volatility that's happening in the pound at the moment, and I didn't want to have that amount of event risk going into the data out today and potential volatility overnight, as I sort of shared with you guys before. So it's a bit unusual trading the pound at the moment. So the market's really a kind of a key part where it's really trying to ascertain what's going to go on with the pound. There's event risk, and the price is being contained between those 100 and 200 exponential moving average, and how it reacts is going to give us an indication of what's next. If it breaks above the 200 exponential moving average, we can look at raising higher. If it falls below, looks like it's going to be lower. So at the moment, the market's trying to decide what direction the pound's going to be in. Obviously, it's a big event risk for the pound, particularly headline risk. The thing to look out for is if you get a resolution of the Brexit deal. And if you get a resolution of the Brexit deal, fair value, most analysts have got fair value of the pound about 1.35. So you could expect from current prices about 600 points. So if you're just on a news feed or you suddenly see, oh, Brexit has been sorted, it's all been organized, then 1.35 is a decent target, and followed by 1.4, those highs there of the March 2018. That's just by way of letting you know. And see, price is trying to push up at the moment and is making its mind up. Now, going on to the next section. So we had this, and then we had the Asian session. Now, during the Asian session, there was one key piece of news, and it was to do with a CEO of Huawei, someone called Meng. Now, she's being detained on charges related to apparently stealing trade secrets from US business partners. Okay, now this aspect here between the US and China trade war is very, very key, and it's all to do with stealing intellectual property. That's one of the big tensions between the US and the China, is that the US is accusing China of stealing intellectual property. So it's no coincidence that Huawei's Meng was detained on these charges, because it's part of that bigger US-China tension. Okay, now that had a big impact on the markets in the Asian session, because the markets are realizing this isn't just about a business partner being detained, as newsworthy as it is. This is an expression of the US-China trade war and some of the tensions that are going on there. And if you look at the impact, you could see that the risk-off tones that happened quite quickly in the market was the Japanese yen strengthened and the dollar strengthened against all these other currencies. Okay, so that's a typical safe haven reaction. you can see that this strength on risk off tones carried into the start of the London session. So we had a scenario where the Asian session was in a risk-off scenario, okay? And then starting the London session, that risk-off environment was still very, very much there and very much alive. So going to the next slide, just again, a bit of context, looking at China's slowdown in GDP growth. If you look at the white line here, that white line is China's GDP levels, okay? So you can see that China's GDP just came out recently at 9.8%. So that's, you know, seemingly quite a good level. But when you look at the GDP growth as a trend, you can see that the trend of China's GDP is down, okay? You can also see that the 5-year moving average is down as well. It's at its almost lowest point here. So looking at the 5-year average, looking at China's GDP growth, you can see that that trend is down. This is one of the reasons the market is really concerned about Chinese slowdown. I shared yesterday in the FX week ahead how China is responsible for around 15+% of the world's GDP. So between the US and China, they got 40% share of the entire global GDP. So any disagreement between those two countries is going to affect the whole world. And this is just to outline some of those concerns about China's slowdown in growth. And that is being felt throughout the world. That's what people are concerned about. And seeing the slowdown in China's manufacturing, their PMI data, is just showing the reality that those chickens are coming home to roost. So in the London session, that story carried on when the China's foreign ministry was asked about would they be retaliating for Huawei's executive Meng being extradited. And the Chinese foreign ministry, was very didn't use quite not aggressive language, but quite firm language, saying that hope the US would correct its mistake immediately and understand what it's done wrong, and that hope Canada and US will correct their wrongdoing. So China, understandably, are very annoyed, and it's just part of that tit for tat that's going to be going on. So that was going on into the London session. So we can see that the London session is in a risk-off tone. Now, here's a question for you. When the market is in a risk-off tone, what currencies are bought? There's 3 main currencies that are bought in a risk-off tone. And what currencies are there? See if you can answer it in the question. We have 1 correct answer. Well done, Nadir. Does anyone else want to give an answer? What currencies, good try, Trib, but that's not one of the key currency that is bought, although that currency has been bought today, and I'll explain why. Yes, Nadir, Nisa, that's correct. The Japanese yen is what's called a risk-off currency, and people buy the Japanese yen when they're concerned about risk. The other currency that's bought, yes, well done, Trib, Japanese yen. The other currency that's bought is the Swiss franc and the US dollar. Okay, so if you look, I'll just type this answer in. So US dollar, Japanese yen, Swiss franc. I should have sent that to all of you. Those are the 3 currencies that are bought in a risk-off environment. So as soon as the market's in a risk-off environment, hang on, these are going to be the strong currencies. Okay, so for example, you'd never want to, if it was in a risk-off environment, you would never want to be selling the yen because you could know that your trade is almost certainly going to lose. Okay, so this is the kind of information that helps you, and a risk-off tone is something that's often spoken about. It's frequently, expressed as that's something you need to really have a good grasp on. Well done, Nadir. Well done, Nisa. Well done, Trubavan. You understood those risk currencies. To help you grow, Nadir, Nisa, Trubavan, the other two currencies for you to remember in a risk-off tone is the Swiss franc and the US dollar. Okay, those three currencies are risk-off. That will just help you. Yeah, good. That will just help you build that in to your mindset. Now, in the London session, there was one piece of key data, and this was the UK November average weekly earnings. Okay, now this has been very helpful because this is also going to help us look at our special topic this week, which is selling the rumor and buying the fact. And I'll get to that later, but you'll understand it as we go through the session. Now, the reaction to this data here was very good. Basically, the November average weekly earnings came out at 3.4% versus 3.3% month on year expected. Okay, so this is very, very good result. This is the highest earnings, average weekly earnings, since around July 2008. So it's a fantastic result, and the general pattern of earnings in the UK has been up. Okay, so there's been this continual pattern of increase in average weekly earnings, and as a consequence, this in a normal environment, this would put pressure on the Bank of England to raise interest rates. So typically, the pound would really appreciate quite strongly on this kind of data. However, as I've said a number of times with our FX week ahead, the situation is unusual. And the situation is unusual because in Great Britain at the moment we have Brexit. So market participants aren't necessarily responding to the data as they would normally with Brexit concerns and worries. Okay. However, we have a little clue here as to how the market is feeling a little bit more confident, because when this data came out, it's very good data, a strong headline, and a number of readings which were at expected levels or thereabouts. And so the end result was this is a very good reading because the expectations were excellent. And I'll show you the impacts on the charts here of those earnings. Now, the impact of the earnings was seen basically here from this level up, okay? And now typically what's been happening, and this is for us to be aware of, is typically what's been happening is when good data's come out for the pound, as of late, the pound has then sold off because of Brexit concerns. But today it's been slightly different. The good news of that good data has had the pound continually being bought is what you would normally expect. And now as we're entering the US session, we can see that the pound is being bought there. Now, I anticipated this, and I was commentating during this European session for the whole session. And as I was seeing this real time, I've noticed there's a shift. I've noticed a change, if you like, in the story. And the shift is, remember what I've been sharing with you guys, the chance of a no-deal Brexit has gone back off the card. So there's less likelihood of the pound being sold. And this for me has been confirmation. Now, price might still go back down. Obviously, I haven't got a magic ball, or whatever, I can't remember the term. I haven't got a crystal ball. That's what it is, to see into the future. But what I can see is the market is feeling more optimistic about the pound and is looking to find ways to get long as the chance of a no-deal Brexit is going into the background. It's receding further and further back. So if one way to have traded this is if when you saw this data come out, you could have simply put a Fibonacci retracement level on the spike, and then you could have entered back in. This would have been a perfect level here, look, because you've got the 50% retracement of the spike from the good news on the data, and then you've got a cluster of the 50, 100, and 200 exponential moving average, and you see it's tested there, 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 and even there. There would have been sensible places to have gone long. And if you were going long at the 50% retracement, another question for you guys, where would have been a sensible place to place your stop? Let's have some sensible places to place your stop if you'd wanted to go long here. So you've got some very good data. You're anticipating the pound to continue to appreciate. You don't want to just buy at these high prices. You want to buy in a pullback. Where would you want to place your stop if you entered at the 50% Fibonacci retracement level, or you entered at the 38.2 level? Where would you want to be placing your stop? Yeah, Nadir, that's excellent. Nadir's just come up with a 61.8 level. That would be a very sensible place. You could place your stop there at the 61.8 level. Alternatively, you could place your stop underneath the low. Now, obviously, if you've got it underneath the low, there's less chance of your stop being hit. However, by placing it underneath the 61.8, you know that you're underneath those moving averages, and you might think, you know, if price is broken through those moving averages, I don't want to be long anymore. Okay, so that's a good place, and places to take profit would be up here at these shoulders, or even at the 23.6 level would be a good places to take profit. Have a look how price is reacting about the 1.29 level. You can see that if you put a horizontal resistance level here across these highs, here, here, you can see that this zone would be a very clear and good place to be buying from. The interesting thing, as I said, is that price is reacting a lot more positively to this good data. You can see that the pound is wanting to go long. Market participants are having more confidence in the pound. My target is I'm currently long here. I'm looking to first of all target the 200 exponential moving average here. Okay, I'll explain how I got into that later, because it helps do our special event. But that's my first target, up that level, just like it was for yesterday's trade in a very similar situation. So looking at the UK, you can see that average weekly earnings, you can see how they've been going up steadily, and the regular pay has been going up steadily. So in real terms and in nominal terms, we've got this uptick and this up movement in UK wages. If UK wages increase, then that's going to put pressure on consumption and inflationary pressure, and it's going to lead more likely to interest rate rises. So that's the connection between the earnings, inflation, and interest rate rises. So that was big news out during the session. So we had this kind of funny time, you know, mid-session, where that's the was the mid-session. Yeah, that's it. So mid-session, we had quite a strong British pound, which was the result of that large spike on that good news. So that's why we saw some pound strength. You can see that pound strength here. That was a mid-European session. It receded a little bit into the end of the session. And so by the end of the London session, we had the strongest currencies with the Japanese yen, the Swiss franc, and the US dollar, because these currencies are all losing value against the US dollar. So they're the three strongest currencies. Can you tell me, why were those currencies the strongest currencies by the end of the European session? Can you tell me what was the reason? If anybody can type that out, that would be great. Why were these three currencies the strongest? The yen, Swiss franc, and the US dollar. Were we in a risk off or a risk on environment? Yeah, that's right, Nadir. It was risk. And it was risk to do with the Huawei saga that I've already outlined. That was what was weighing on market sentiment. The mood of the market was, this is risk off. We're concerned that this is going to work badly for us. And you can see the yen was bought, the Swiss franc was bought, the US dollar was bought, and then you get the commodity currencies, which tend to be sold in a risk-off environment. So the Australian, New Zealand, the Canadian dollar, those commodity currencies are sold. The Australian dollar was sold the most. Let me also show you some of the, I'm just going to pull it up on my other screen. I'm going to show you some of the ways that the European and Asian indices reacted. So looking here, so I'll just get rid of that for now. So if you look at the indices as well, you could see that the Asian session, that the Shanghai index, the Hang Seng index were down one. Remember, to notice a big change, anytime something's down 1%, that's a big change, okay? So we had this sort of, it wasn't a very strong risk off environment, but it was still strong. It was still a risk off. So you had the Shanghai down 1.18, Hang Seng down 0.70, and then coming into the European session, the European indices were down. So the UK FTSE 100, the Euro stocks, blue chips, the France CAC 40, the German DAX, all those down nearly 0.5%. You had the Spanish IBEX, the Italian FTSE nearly down a full percent. Okay, so you can see these European indices were down on risk. And going into the US session, look, we had the Dow futures down 0.57%, the S&P 500 futures down 0.59%, and the VIX, which is the volatility index, is nearly up 5%. When that's up, that's a concern. Okay, the volatility is there. So very firmly in a risk environment. So by now, you should see that we are. This was the strength and weakness by the end of the session. We had strong yen, stronger franc, but look at the percentages. It's not a huge move. Okay, so it's been a quiet session. So there's potential for those movements to carry on gently or to be reversed. So with a sentiment in a session, you have to keep your ears to the ground. And putting it into a bigger context, we know that Donald Trump does not want a US-China trade war to really develop, because he likes the Standard & Poor's 500 going up. And if the market gets too spooked, the S&P 500 is going to go down. So we know Donald Trump has constantly been saying recently, oh yeah, we're making good progress with trade between US and China. Positive things will work out, because he knows if he's too negative, the market will most likely react. And he has to be very careful that it doesn't happen. But at the same time, the real issue between US and China is intellectual property. That's the big concern. That was the issue over Huawei. That's the sticking point. So you can keep your ears and eyes peeled for issues regarding intellectual property. Looking forward, now we've looked back. So we now have a really good environment, don't we? We know we're in a risk-off environment. We know the weak, we know the strong currencies, and we know why they are in that current situation. So we look forward. I've gone through that, and this was just to show you the way they flow through, okay? Because we had the fall in the Asian equities that led to fall in the European equities that in turn are leading to a fall in the US futures market. So when the S&P 500 open, then it's possible that they're going to open down, okay? So you see Asia fed into Europe, and will Europe now follow into the US? So that's what we're trying to look at. And sentiment can change during sessions, or it can carry on during sessions. So you have to have a sense of adaptability to be able to read what's going on. You might want to have a number of different markets open, so you can be reading them as they're changing. I've got a number of markets I can just flick up to here on my laptop, but obviously the majority of them I've got on my Bloomberg and Reuters feed, which I use, which has a whole selection like you have here, which I'm able to use today to make that clear for you guys. Okay, now we go ahead to the European session. Just a reminder that we've got a partial government shutdown in the US, longest ever period, now in its 32nd day, and the general market sort of feeling about this has been it's not a big problem, because I showed you this data before, that when the US government has been shut down previously, going back to 1976, it has had a negligible effect on the S&P 500 return. Okay, so the market has generally said, well, government shutdowns don't really affect the US economy too badly, so we're not gonna be too worried about that. Right. The problem is the longest one here was 21 days. We are now in the 32nd day, and so that will be, if it goes to the end of this week, that will mean some people won't get their paycheck for a second month in a row, and that will obviously start weighing on the fringes of the US economy. Workers, 800,000 workers potentially affected. That's a lot of people, and that will start to weigh on the economy if it drags on. So just to be aware of that, look out. It's a risk event. It's something that could start to really weigh on the markets. But that's, just looking forward. Again, we're looking forward at Draghi. He's going to be speaking about monetary policy this Thursday. So we've got some quite strong potential risk for the euro going ahead. And if you look at the data coming out for the rest of today, we don't have that much going on in the US session. We've got some manufacturing and wholesales data out of Canada, nothing particularly market moving, but the big event is the CPI data out of New Zealand. Now, if you look at this in New Zealand, there's just something to show you. Can you see that 0.0%? So that is the expected CPI data, which is a really, really soft number. The previous number was 0.9%. So the data that's expected out of New Zealand is 0.0%. Now, when we're selling the rumor and buying the fact, what we're looking at sometimes is we're looking for rumors or indications of bad numbers. And this is a good example, because look, the CPI data out of New Zealand is expected to be quite low. Okay, so if the CPI data is going to be low, that's the key kind of factor for whether a country raises or cuts its interest rate. So CPI data is really looked at carefully, and this is only released once a quarter for New Zealand, so it has even more potential to move the market. So this is a big risk event that is ahead. So what we want to do in this situation is, if you just go to the chart, we'll look at let's look at the New Zealand US dollar. You can see the pound is continuing to appreciate there, breaking those highs that we had earlier. Let's have a quick look at New Zealand US dollar. There we go. Like you can see the market opened. Where did the market open here? Yeah, the market opened here, and you can see the New Zealand dollar has just sold off. Okay, now part of the reason New Zealand dollar is just selling off is because of this really poor data that's been expected. Okay, so we're expecting a poor number, so the market members always trying to think about what's happening next. This is sell the rumor and buy the fact. So what you might find is the New Zealand dollar reverses once that data point is released. Okay, so you can get some good trades sometimes by looking at what's expected. I'll run that through with you again. I'm going to show you a few examples, but that's just one that's potentially coming up. It's a bit too late to go into that trade now, because you've got the data coming out. Some people will be profit taking into that, so I'm not suggesting that now unless from very good technical levels. But that's the kind of situation you want to look at. Now, the only interesting thing about this New Zealand dollar CPI data that's out later is there's two different releases, which is a bit complicated. I'll explain it to you though. The first CPI data out is the one that's scheduled here at 10:45 GMT. Okay, that data is expected to be a soft reading, but there's another reading that the Reserve Bank of New Zealand prefers for inflation, and that's called the core inflation level. And according to the sources I've been reading, there are some analysts who think that that is expected to be a bit higher. I haven't been following the New Zealand economy very closely, so this is something I'm just being guided by other analysts. So but there's this expectation that the actual core reading, which is released 2 AM GMT, and that's the Reserve Bank of New Zealand's preferred data. So in other words, that's the data they're going to be going by. So because that's the data the central bank is going to be going by, that's what the market participants are going to be going by, because we want to know what the central bank is doing in order to get the path of direction. That's just to help you as we look forward. So if you're looking at trading the New Zealand dollar, be very aware of those environments, and at least you know what the expectations are. And if you go to the daily chart, you can see, you've got this cluster of resistance overhead with the 100, 50, 200 exponential moving average. So that will gives good places to define and limit risk. On the daily chart, on the 4-hour chart, again, you've got these key levels here. So you can interpret the data, use your levels, and that can be ways of getting low risk, high probability trades out of it. So here we go. Back now. It's back out. Oh, guys, where are you? Let's just check you're still here. Oh, that's good. Oh, that's great. Sorry, I just lost the panel. Now, here is a question for you. Now, going into the US session, what is your currency bias for your session? In other words, which currencies would you be looking to trading based on the environment I've shared with you? Okay, so remember what we want to do. We want to pair up weak and strong currencies and write them down. So which currencies are currently going to be strong? Which currencies are strong at the moment? Like Nadir, yeah, good. The pound is strong at the moment. The risk with the pound is Brexit headline risk, but very well done. The pound is strong. Which other currencies are strong? Yes, Nadir, the Swiss franc. Olufemi, very good. The Japanese yen. Right, so now we're starting to see some strong currencies, aren't we? Okay, so we're seeing strong currencies, the pound, and we have our reasons why it's strong. Good data and Brexit no deal risk receding. Okay. Then we have Japanese yen. On risk off. Okay. And of course we have US dollar on risk off as well. Okay, US dollar strength. But as I said, be aware on the US shutdown is risk. Is risk for US dollar. Right. So there we go. There are strong currencies. Now, which ones are our weak currencies? Start typing away, guys. Tell me the weak currencies. Here's a clue, which currencies tend to be weak in a risk-off environment? Well, very good. Olufemi, we have Canadian dollar. Yeah, Trib, well done. Australian dollar. New Zealand dollar. Right, now you see we had to do all that work to start getting our currencies into order. But now we've done it, which currency pairs will we be looking at trading? Let's have some suggestions from you. Which currency pairs will you be looking at trading? And be trading a strong against a weak. Have a think. Go on, guys. Give yourself a think. I'm waiting for your answers. Give me some CAD yen. Yeah, that would be a weak against a strong. New Zealand dollar, Swiss franc. Yeah, I like it. Okay, I like it a lot. That's very good. Australian US dollar. Yes, Nadir. That's very good. US dollar, Canadian dollar. Excellent, Tribuvan. That's very good. If you're trading the Canadian dollar, what other market do you need to be really aware of? Here's another question for you. Oil. Very good. Remember, there's a strong correlation between oil and the Canadian dollar. So if you're ever trading anything with the Canadian dollar in, you always want to look at the oil market to see what position the oil market is in. Right, so now there we have a good number of different currency pairs that we could be trading going into the next session. Okay, so I'm looking, let's take a strong with a weak. I think the strongest was the yen, and I think the weakest was the Australian dollar. So let's look at a Australian yen short. Okay, we want to sell the Australian Japanese yen pair. Okay, we've managed to identify that. So going to the charts. Okay, here is the Australian Japanese yen chart on the 1 hour chart. Okay, and I will, looking at the chart, let me just point out some technical areas. The red line is the 200 exponential moving average, the blue line is the 100 exponential moving average, and the middle line is the pivot point. Okay, where do we want to be selling the Australian Japanese yen from? Which levels make sense? Let me know, guys. I'm also gonna, while you're looking at that, I'm gonna be also looking at this chart. I'm pulling up another Australian yen. And let me just pull that up. See what price is currently at. And there we go. All right. Let's see what price is. Chart. Always go down to the 15-minute chart as well. Okay, so let's see what we got. Where are we looking at? Yeah. Okay. So Nadir, the 200, Nisar, the 50, that is good places. So what we would want to do is we want to wait till price returns up to the 200 or 100 exponential moving average. We can enter short at those levels, and an obvious place to put your stop will be the other side of the pivot point there. Okay, because we know that if price goes through that pivot point, most likely something has changed. There's been some kind of difference. But if the market conditions remain the same, selling from the 200 and 100 exponential moving average with a stop above there makes sense. And if price goes through but the situation still remains the same, then selling from that resistance 1 level would also make sense as well. In fact, you could get a better price. So there are some of the levels that we'd be looking at selling from. The 200, 100, stop above the pivot point, or the resistance level there. That would be how we do it. And with the other pairs you've mentioned, you just go through and do exactly the same process. Looking at the chart itself, the other way, you can draw a Fibonacci retracement level from yesterday's highs. You can see this was the highs of yesterday going down here, and you can see, look, a good place would be the 50% moving average, exponential moving average, with your stop above the 200 exponential moving average and playing a low down to there. So that area will be a key area to look at, and then how it reacts to the 50 exponential moving average potentially would be another good area to get short in. Okay, so that's how you start to define and limit your risk. You pick your currency pairs, and those other currency pairs that you mentioned are fine. You know, you can go away, Nisa, and look at a New Zealand dollar Swiss franc short. You can go away, Nadir, and you can look at a New Zealand dollar US dollar short, but remember the risk event that's coming up. And Trib, you can go away and look at a US dollar Canadian dollar long. okay, as you're looking at the strength of the US dollar against the weakness of the Canadian dollar. But remember, the US dollar Canadian dollar pair has a 96% correlation with oil. So flip open your oil charts, look at your oil charts before you start trading any Canadian dollar pair, right? So look at your risk. I've covered that before. So risk, when I'm trading for my fund, I don't use leverage. So, or if I use leverage, I use it very rarely and only 2 to 1. So in other words, I recommend, especially when you're learning trading, or you want to be a serious trader or want to submit your results to a firm or a fund, then I recommend not using leverage or very limited. So make sure your risk is tolerated. The last thing you want to do is to take too big a risk, lose your account, and then you won't be able to trade anymore. And you can't make money, and you can't develop, and you can't put more money into your trading account if you've lost it or lose it all. So make sure your risk is under control. This is how to sell the rumor and buy the fact. Yeah, now I wanted to show you, let me just show you. Okay, here's a selling the rumor, buying the fact trade that I'm involved in now. Okay, so basically the European Central Bank has a problem, and the problem is, if you look here, these manufacturing PMI datas have been falling for months. Okay, you can see, look, the ECB is slowing down. We had very slow growth coming out of the Eurozone, and Germany had some PPI manufacturing data out yesterday. It was a bad, and many commentators are talking about this. The Eurozone is slowing down, but the central bank don't seem to be reacting. Okay, they don't seem to be reacting. And so what the market is starting to think now is that when Mario Draghi has his monetary policy on Thursday, surely he's going to be reacting to this slowdown in Eurozone growth. So the rumor is that Draghi will start reacting to the slowdown in Eurozone growth. So that's negative for the euro. So that's a negative sell. Now, by contrast, I've paired that trade up with oil, which has been supported by a number of factors recently. We've had OPEC, which has been explaining that the cuts have been, taking effect. Some storage has been less, inventories have reduced, the oil price of the market has been rising, and there is quite hope in the oil market that US oil rigs here, you can see that the number of oil rigs have fallen quite considerably, just going underneath June 2018 lows. So the idea of less supply, the IEA came out and said global demand is expected to be the same. So all these things have been weighing and giving a strong buy to oil recently. Okay, you can see that it's been bought when you look at the chart. So I paired these up together, negative euro, strong CAD. Remember the relationship between oil and CAD. If oil is up, CAD's up. So I was looking for CAD strength and euro weakness. Obviously that trade is frustrated by the risk off environment today, because CAD is also a commodity currency and tends to get sold on the kind of the risk environment. But what I did, this is how I define and limit my risk. Price was here on the daily chart. I can see price was breaking through the support zone, testing and breaking through the 200 exponential moving average. I like the trade. I could see I took it at the start of the week, and I entered just above the support zone, and I'm looking to target down here, down to the 1.4900 level, and I'll be playing that by ear. But what I'm doing is I'm selling the rumor of that anticipated slowdown. Okay, do you see? That's how you're selling the rumor. So you sell the rumor, and if price is in decent profit, I might just take it off the table before Mario Draghi speaks, because when he speaks, he might say something different. But at the moment, is expected to maybe acknowledge the slowdown in European growth. See, that's where you get to sell the rumor by the fact. That's how it works. I'll show you another example. This was an example today. So I re-entered my pound position by doing the opposite of selling the rumor and buying the fact, which is buying the rumor and selling the fact. So here I could see, look, at 9:30 GMT time, I could see, look, the market was expecting average weekly earnings of 3.3%, okay, and a weekly earnings excluding bonus of 3.3%. Now, when you looked at that in the context of the Great British Pound, they were really good numbers. So I was like, oh, hang on, you know, I was here on the chart and I was looking as price fell down towards that 200 exponential moving average. This is on my platform, and as price fell down, I said, and I was calling this live at the time on a European session that I was covering, and as I was seeing it go down, I thought, you know, hang on, price is not going to break through that 200 moving average because the expectations are really good. You know, the data is expected to be really good. And sure enough, what happened was the price, the pound was bought into the data. Now, one of the things, a little tip with the pound, is that the pound's data is quite widely shared before it's released. So certain people are allowed to see the data before it's released, but it's quite a lot of people in Britain. And obviously some of that leaks. So sometimes you can see the pound reacting before an event, and sometimes that's a clue that people know what the numbers are. I picked up on that clue and I thought, hang on, I think we're going to get some very good numbers here. And so I bought in the pound just as price was, I could see this reaction. I used my reasoning. I bought the rumor and sold. So that was it. I bought the rumor, and the rumor I was buying was this very good average weekly earnings that was expected. Now, I didn't sell the fact because I've shared with you earlier that as I've been looking at the pound, let's see where we are. As we've been looking at the pound, I've been wanting to go long on the pound for some time. I've been looking at this 200 exponential moving average as my target. I've seen this as a very good place to define and limit my risk. That is my destination, but even there, I'm going to look carefully how price reacts, because I think we could see a break above that 200 moving average, which would be key. You see, if you get the price above that 200 exponential moving average, then we're looking at more upside. So I'm trying to go for more with this trade. I will obviously play it moment by moment, because that's the way you have to trade, because you can be convinced of something 1 hour and then it can all change the next hour simply because there's new information. Okay, so you have to respond, you have to react. Don't marry your position, but be committed to your position and be ready, prepared to change and adapt. So that is the workshop that we've just done. I hope you've all enjoyed it. Please, guys, remember, use your crib sheets, the sheets I've given you in the handout. Use them week by week. I've been impressed with some of the questions. Guys, you were doing a very good job. Olufemi, Nadir, Nisa, Chib, well done in recognizing the weak and the strong currencies. Repeat that day after day, week after week, and follow the market narrative, and trades will start jumping out at you. Okay, you'll start to see the things. Oh yeah, you're welcome, Nisa. I also want to let you know about a service that HYCM do. Now, with this service, is if you submit a deposit of $1,500, $3,000, or $10,000 as part of the incentive for submitting the money to your trading account, you get a one-on-one coaching session with myself. Now, these one-on-one coaching sessions can really help you to really get to that next level. So you can just explain the problems you've got. I can speak to you one-to-one. One of the weaknesses, obviously, with this webinar is I can't get to speak to people individually very easily. You're welcome, Olufemi. And these different services allow me to speak with you, to help you, and you can speak back with me, and I can give you a plan of how to improve your trading. What happens with these is I have a questionnaire. I get to know you a little bit via the questionnaire. I ask you some more questions when we're doing the webinar, and then we go over the most relevant topics that I consider will help you most of all. So be aware and that this offer is there by HYCM, and if you take it up, you get these coaching one-on-one sessions with myself. I've done a few of them already, and they are good, and I think they are helpful for people. So just don't forget that. And the next webinar will be on the 28th of January. We'll do the weekly FX week ahead, and then obviously I have the workshop coming up again next week at the same time, 1 o'clock to 2 o'clock. So thank you very much, one and all. I hope you've had a good session, and don't forget your handout, repeat what you're doing, and come back and why don't you let me know how you're getting on. If you keep sticking with it, then eventually these things will become easier for you. And just as a way of helpful guidance, I think you need about 3 months of doing this every day before you start to really get into a groove. It takes a while at first, so if you do it 3 months every day, that will be a good start for you. Thank you very much for attending the HYCM's online trading workshop, and I hope to see you again next time. Thank you and goodbye.